Pay tax now to never pay tax again. That's what we're going to be going over today. Hey guys, Mike, CPA, partner with Ledgerly, tax strategist, as always here to give you guys the latest and greatest tax strategies, whether it's beginner level or more advanced level. Today, we're going to be talking a little bit more advanced level, that being Roth Chunking. So if you love topics like this, make sure you hit that subscribe button for weekly videos on the latest and greatest tax strategies. So the concept of Roth Chunking is where we take traditional dollars, whether it's traditional IRA or traditional 401k dollars, and bring those over to the Roth bucket. Now, Roth IRAs are magical. Yes, they're not tax deductible. So you're essentially paying tax on your contribution. For 2025, it's still $7,000 and it's $8,000 for individuals over 50. But that $7,000 that you put in is going to grow and grow and grow and compound and compound and compound. So if that 7 grows to 20 or 30, that entire amount is going to be tax-free, the basis and the growth. So we can go on for days about Roth IRAs and the concepts of how great Roths are. But today we're going to be talking about chunking. So let's go right to the whiteboard. All right, so we're at the whiteboard. Again, we're going to be talking about Roth chunking today. Now, before we get into the concept of how to properly do chunking, let's get a visual on the board. So essentially, there's 4 main quadrants when it comes to retirement accounts. So let's draw them out. We have our traditional IRAs. We have our traditional 401ks or 403bs or, whatever it might be if you work for a not-for-profit or government association. But the same thing, traditional. It's tax deductible dollars. So traditional IRA, traditional 401k. What do these mean? That means you got a tax deduction for putting it in, but then it's going to be taxable when you take it out. It's going to be a taxable distribution when you take it out. Now, on the flip side of the coin, we have Roth. We have Roth IRAs and we have Roth 401ks or 403bs again, whatever it might be. Now these, you already paid the tax. So you're done. You already paid the tax. Tax-free, baby. Okay. So now that we have it on the board, we have the 4 main quadrants. We have the traditional and the Roth, and how it's split between the IRAs and the 401ks. The goal of chunking is we want to take the Roth IRA here and we want to move your traditional dollars over here into the IRA. If you have a Roth 401k, your employer is most likely not going to tell you about it. So you got to do your due diligence and dig into to see if the plan that you have has a Roth component. We highly advise with the 401k, do it Roth, do it up to the match. Whether it's a 3% match, 4% match, 5% match, do it up to the match, get out, start doing the Roth IRA. So the Roth 401k, keep it where it is. The Roth IRA, we want to move these traditional dollars over there. So let's get into how this exactly works. I'm going to draw this out, so bear with me, everyone. We're going to get our good old math days back with a nice little line graph. So on our vertical axis here, we have our tax brackets. And then on the horizontal axis here, we have our taxable income. So our tax brackets, these are going to be in percent. I did that backwards, but you get the gist. We have our 10% bracket. We have our 12% bracket. We have a bigger jump up to 22, smaller jump up to 24. And then we have a big jump up to 32 and so on. We got 32, we got 35 and 37 at the top. So the way that this works is as your income goes up, your tax bracket goes up. So we think about this as going up the stairs, 0 to 10, 12, 22 to 24, 32 to 35. Now this is not accurate, not drawing the scale. It's very messy, but the whole concept of chunking, let me take a step back. When we put our monies into these traditional accounts, what happened? We got a tax deduction for it. Now we're talking about converting it to Roth. When you take the money out, you got to pay tax, right? So it's almost like art. It's like a piece of art, like what we're doing right now, my chicken scratch. The whole concept is when we start converting, it becomes taxable income. So the goal is to keep it out of these areas. These are big jumps, 12 to 22%, 24 to 32%. We're talking a 10% increase here and an 8% increase here in your taxable income, right? So for example, if you're making, let's talk about a single person. Let's say you're making 182,000, you're basically at the cusp of that 24% bracket for your taxable income. So anything over that is going to push you into 32%, which is this 8% spike. So that's where we want to be careful. I think about pro athletes or celebrities or models or influencers, people that are out there making a ton of money, the traditional accounts are going to benefit them. It's a tax deduction. But I don't know about you. My arm's kind of shot. I'm getting old, 30, big whoop. I wouldn't be able to play football for more than 5 or 6 years. So 5 or 6 years from now, if I was in the NFL and I'm ready to retire, those traditional accounts were going to benefit me. Now, let's say my income takes a step back. Let's say my income was up here. Now it's here. Get what I'm saying? Now we can start chunking every year into the buckets. Yes, you're going to pay the taxes in the year that you convert from traditional to Roth. But once it's in Roth, baby, you never pay tax again. All right, let's take a step back here. This is a great strategy to take dollars that you already got a tax deduction for, pay the tax now, and never pay tax again. But does that mean that right now is the right time for you? We don't know. We don't know what tomorrow is going to bring. The other caveat that we don't know is no one knows what those future tax rates are going to be. Remember the vertical access? 10, 12, 22, 24. Is that going to be the same 5, 10, 15 years from now? Maybe, maybe not. I don't know. But here's what you can take control of. You can lock in that tax-free mindset by paying the tax now, letting it grow tax-free forever. And when you take it out, you're never going to pay income tax on it again. 20, 30, 40 years from now, if I look back at myself, I'm not going to say, oh yeah, I remember that tax return in 2022 that I filed. I converted $50,000 of traditional IRA monies over to Roth. Okay, well, maybe I paid $5,000, $6,000 in tax on that 50. I sure as heck hope that my money 30, 40 years from now grew more than $5,000, $6,000 in the Roth IRA in the market. That's the mindset to have, everyone. So again, a very advanced topic, but again, take a step back. Rome was not built in a day. That's why we're here for you. We're here to help guide you to take those right steps. When is the right time to do it? Do we just rip off the Band-Aid now, or do we do it in chunks? But you're not going to know unless you do your due diligence. Get in touch with us. You like these videos, you comment, you subscribe. Go to our website, lock in a consultation, and let's start building that tax-free generational wealth for you.